One of the biggest things would be in Canada, we are guaranteeing our loans, right? Like to get a non-recourse loan, you'd probably be 50% loan to value, maybe 55%.
Yeah.
One of the biggest things that we try to protect against is like we run several different sensitivities, right? So one thing that we're able to do is really focus on or control our costs, right? Don't put everything into this for lots of reasons because I don't want that responsibility, and there is a risk, right? Real estate is tough, right?
Yeah.
And there is risk, and I feel that oftentimes if you're new, like it's just like sales, right? If all you ever talk about is the great things that are going to happen and what I call like blue sky thinking.
Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Shane Melanson. He is a commercial real estate developer based in Calgary, Alberta, and has completed over $100 million in construction projects across Canada with a focus on townhouse rentals. So thank you so much for being on the show today, Shane.
You bet. Good to be here, Charles.
So give us a little background on yourself prior to getting involved with commercial real estate and development.
Yeah, I guess just kind of how I got into real estate, if you will. I mean, I'm from a smaller town, Whitecourt, Alberta. Both my parents were teachers. And I initially thought I was going to get into oil and gas. That was kind of the path to making money. That was kind of what I was focused on when I was younger. And came to Calgary in 96, went to U of C, University of Calgary, got an economics degree and with a concentration in applied energy and a minor in management. So I was really focused on getting into oil and gas. That was kind of where I thought I would end up. But in 03, 04, there wasn't much in the way of jobs. So I ended up actually at the city of Calgary and got into assessment. That was like appraisals, assessment. And that was kind of my introduction into real estate. And what initially happened was I would get tasked with looking at houses that sold in the same year twice. And what I was focused on was like, were they fraudulent or what was going on? And really what it was investors buying and flipping, right? And that was something that was kind of new to me. And so I remember going out for lunch with one of the kind of senior assessors, and I just asked him like, what was this, like, what was going on? And he kind of explained it to me. And I thought, well, like some of these guys must be making $100,000, right? Because I'd see the sale prices anywhere from 100 to 250,000. I didn't really understand that you had to put, how much went into it, but that was kind of my introduction into investing. And so I slowly got into it. In 2006, I moved over to commercial finance at Sun Life. And so I was working on larger projects to understand how people bought and sold, $5, $10, $20 million commercial properties. And it was the first time that I'd seen a syndication. I still remember there was these two individuals that were essentially buying. It was a strip retail, and I think they needed. It was like, let's say it was $10 or $12 million, and they were putting in $3 million of equity. And I was thinking, like, how did they come up with it? But they had raised about 75% of it from limited partners, and so they explained, and I just peppered them for like 2 hours, and so that was kind of my introduction into syndications. And anyways, we can kind of jump off wherever you want, but that was kind of how I went from res to commercial. And then my father-in-law, who's a big developer, they've got a publicly traded company. He kind of took me under his wing and then showed me, how all the pieces fit together. Because it's one thing to see things kind of piece by piece, but it's very different when you get behind the curtains and you see how a deal is actually put together. So yeah.
Especially a development project, there's so many moving pieces there, and between dealing with cities and government and then everybody else that goes with it.
Yeah, I mean, development, like I started off doing kind of value add, which is probably what most investors, focus on, if you will. And then we bought mortgages. I was very opportunistic when I started. I wasn't very strategic. It was just really like, where could we make money? And that was good and bad. but that led me down to an 1,150 acre mobile home community that we developed. And then we went into industrial, like light industrial development, retail development, which I still do, but I'm not a fan of today. And then over the past 3 years, I've been really focused on built to rent for in townhouses, right? Anywhere from kind of 20 to 100 and some units.
So yeah, that's what I'm about to get into is that about your current business. So your current investment criteria is really working with those townhouse communities. I mean, what else do you guys focus on other than townhouse communities, or is that really your primary focus?
It's my focus right now. Like I mentioned, I have two retail projects that are ground up developments, one with McDonald's, another with a Wendy's and a gas bar. And, we're talking to Tesla and for an electrical station. But I find those deals to be pretty skinny. Construction costs are a lot higher, even if you get the land for, a pretty reasonable price. I'm just finding it's harder and harder for retail tenants to pay the rents, and as a developer to make the numbers make sense at the end of it. So it used to be when I started in kind of 2016 doing these commercial projects, retail looked pretty nice. Today that's maybe that's just in our market or my perspective, but it's pretty challenging. On the townhouse side, it's very different, right? Because you're in the US. And so like how we get our construction financing is it's much different than building or developing in the US. And I'm not going to pretend to be an expert in the US because I haven't done developments down there. I have bought and sold, so I understand kind of, the nuances of commercial financing in the US. But yeah, it's very different, and we can go into it if you like.
Yeah, give us that's one thing. Give us a little breakdown of some of the main differences, let's say, between financing, for example, but commercial property investing, as you've seen in the U.S. or heard about, but really what happens in the United States and in Canada.
Yeah, so one of the biggest things would be in Canada, we are guaranteeing our loans, right? Like, to get a non-recourse loan, you'd probably be 50% loan to value, maybe 55%.
Yeah.
Every development, I would imagine in the US as well, you're going to be, guaranteeing, just because it's the highest risk. And so banks really want to make sure that they can hold your feet to the fire. From that perspective, it would be similar. But then on your takeout financing, the banks continually want that recourse. And so leverage amounts, I don't know if it would be that dissimilar. I mean, one thing I will say is CMHC, which is kind of like our government body, which would be maybe like a HUD or a Fannie or Freddie down in the US, they are really encouraging new rental product, right? Because there's a real lack. And so depending on the market you're in, they will entice you by going as high as 95% loan to cost, not loan to value, provided you hit, a debt cover ratio of 1:1. And so CMHC is really encouraging developers to build rental product, because in markets like Vancouver, Toronto, which are larger and developers can usually build and sell, developers they can make a lot more money building to sell condos, for example, than they will for rental product. In my market in Calgary, it makes more sense, at least for me, to do rental. And I just don't have the skill set of building for sale. So that's kind of why I've shied away from it.
Why do you think commercial real estate might be a better investment strategy versus residential for many investors? Because you're dealing a lot with residential. You're obviously doing development for it, but you work a lot as well in commercial. I mean, what kind of investor should be more focused on one versus the other in your experience?
I mean, that's a good question, because I literally just did this on my podcast last week, where I kind of outlined like 10 of the lessons that I learned. And I used to have kind of like very narrow focuses on, okay, like commercial is the best, or light industrial is the best, or multifamily value add. And the reality is, like, it really depends on the where you are in the market cycle, what your experience is. And so for me, one of the big things that I focus on is like, where do I have a competitive advantage, right? And so I think the average person, if you're just like, so I would take a step back and say, are you an active or passive investor? If you're a passive investor, then you can pick and choose depending on your risk profile, what you understand, who you're dealing with. I would kind of ask those type of questions. But let's pretend that you're an active investor. I would really be asking the question, like, why do you have this unique or competitive advantage over everybody else in the market? And so for me right now, because I'm a partner in a construction company and we build 300 plus townhomes a year, like I know it pretty damn well. And I'm going to have an advantage over someone that is just a developer or someone that is just a builder, right? So my partner and I, like, by bringing those two skill sets together and me really having, the finance and underwriting and some development experience, it works to our advantage, if you will, right? And so I think that that's key distinction. I mean, there's industrial developers here that have built 3 million square feet. So they know things that I'm not going to know: turning radiuses, bay depths, and like, crossdock, and, all the different things that, because they understand who their tenant is and what that tenant wants. Just like when you build 300 units a year and you start walking with tenants and you start to understand, like, who's the demographic, what are they looking for, what do they want? You just start to get a sensitivity for that. And I think that's really where, it's little things, but they make a big difference. And every project we learn something on.
Interesting. So as a developer, and I mean, how would you suggest, and how do you protect against any type of downturn in the market?
I mean, like, one of the biggest things that we try to protect against is, like, we run several different sensitivities, right? So one thing that we're able to do is really focus on or control our costs, right? I would say that's probably one of the biggest risks. Interest rate risk. I mean, right now, I think the biggest thing you can do is just have more equity than you think you're going to require. One of my contemporaries, or whatever you want to call it, he said, like, double the length and double the costs, and you'll, like, to really stress test it. I feel when I see most pro formas and I talk to newer developers, someone that hasn't gone through a cycle or hasn't had their head kicked in by a project or two, I would say their base case, it should be the most optimistic case, and they don't even run pessimistic. Like, they're not projecting, like, rents dropping by 100 or 200 a month. They're not projecting rent, interest rates to go up by 1 or 2% or even 3%. I mean, and I was guilty of this even on my last retail project. We were building when interest rates were 2.5%. I put them in at 4, thinking I was being conservative. Well, now they're 6.5.
Yeah.
Right. So that pro forma is just hammered. One of the nice things is we've got partners with deep pockets, and we basically said, look, this is still a good project. Unfortunately, what we thought we were going to get in terms of debt, it hasn't panned out. And so, yeah, I think that those are, just having more conservative debt levels, being a little bit more practical on what your rents are going to be. Those are some of the things that we look at in terms of, like, how we're hedging against risk.
So with your strategy with building townhouses, it sounds like your strategy is obviously building them, but also you're going to refinance them and you're going to hold them for what is really your term that you would tell investors, or that you usually try to tell investors is your business plan for hold after that.
So this is kind of evolving for us in the sense that, number one, when you do CMHC, you're really not doing a refi at the end because you're getting 95% of cost. Like, the construction terms out, if that makes sense, right? Like, it's not like your traditional, like when I was building commercial, for example, you go in with your construction financing at, call it 75% loan to cost, and then the value on the back end, you're almost able to pull your equity out, once it's complete. In a multifamily or townhouse project, you're really you're going in with skinny equity, and the plan is that you're not going to need to increase that equity. I've seen some developers that underestimate, and then they get to the end and the bank actually says, you know what, your rents aren't where they said they were going to be, your costs are higher, interest rates are higher, you've got to put $1 million, $2 million of equity into this project. And so those guys get squeezed hard. So that kind of deals with the takeout. As it relates to what's our plan or our exit, if you will, it depends on a few things. Right now, if I raise money from outside investors, most of my investors actually are looking to turn these properties. So they're happy if we build it, stabilize it, and sell it. That's not really what I want to do, but it's not entirely my decision, if you will, right? So if I've got 5 investors in a deal and 2 or 3 of them are saying, hey, Shane, we're okay if you hold it, but our preference would be to capitalize on where things are at. Can we sell it? Then we'll certainly explore those options. Lately, I've been primarily trying to do deals without investors. So if I can do the deal without a limited partner, I will. More control, less people I have to answer to, and obviously more upside and more profit. And so we are starting to do that, and then I can do whatever I want, if that makes sense. Like not to be, like just all about Shane type of thing, but that's just the reality, right? I mean, if you have other investors, then you have to take into account what they want. But if it's your project, then you can do whatever the hell you want, and that is kind of a liberating feeling, if you will, because I've raised a lot of money over the past, call it since 2008, and only recently have I started to do some projects just on my own. And there's no perfect or one way to do it. It's just having that flexibility to do either or.
So over this, say, 15 years of raising capital, what are some of the most effective ways that you have utilized for growing your investor base?
Well, I think first and foremost is putting our investors first. And I know that sounds trite and that everybody says that, but I can tell you there have been projects that we could have, as the general partnership, like per the GPLP agreement, like we were entitled to certain things, but we just did not take them. Because we said that the investors would get a certain return, and if we didn't hit that return, then as a GP, I didn't feel that I'd earned it, frankly. Just and so I've had other situations where we worked for free for 3 years, right, to make a project pencil out. And so all of these projects and deals that maybe don't go the way that you want them to, when your investors see that you've got their back and that you're going to work through it. I mean, you just think of COVID, you think of, through 08, like there's been, like markets are not always like a straight line up and to the right. They've got a lot of turbulence. I've been in projects where I had to sell my house in order to inject more equity because I didn't want to go back to my investors. So there's these circumstances, and I don't go around, telling my investors, this is what I did to help you, but they find out and they know that they can trust you. And so that in and of itself, I think really establishes that kind of credibility and trust. And so now when I go out, and then obviously, when you've got a track record and you've got full turns on deals, they want to come into your projects. And so I can speak to investors. I understand their concerns. I've probably had 500 conversations, maybe that, I don't even know how many, right? But the more you have those conversations, you understand, what are they looking for? What's the question behind the question, right? Because they might ask a question, and I used to think like, okay, so I'll just answer the question. But the truth is they really were getting at something else. And so I'm always trying to figure out, like, what is it that they really want to know and understand? And let's have a conversation around that. So we're not dancing around for friggin' 30 minutes and find out that fundamentally you want to know X, Y, and Z. Like, let's just get right to that. And I have no, like, I think one of the things I'm focused on is I will tell them the risks, and I'll tell most people, like, I'll give you an example. So I've got a few individuals that I kind of have an idea of how much liquidity they have. And they're asking, okay, so how much can I put into the deal? Like, what's your minimum? What's your maximum, right? You hear all these kind of questions. And generally what I will do is I'll say, like, look, most people come in for, let's just pick a number, 250 or 500, but I might have 2 or 3 deals this year. And so if you put in 250 and that's kind of like everything that you've got, the next time I have an opportunity, A, you're not going to be able to participate. B, someone else might come along with a better deal that you want to put some money into, and you're going to be pissed and you're going to want to pull money out of mine to put into theirs. And so I just try to have, like, real honest conversations where it's like, this isn't the only time you're going to see a deal from either me or someone else. So don't put everything into this for lots of reasons, because I don't want that responsibility, and there is a risk, right? So I think those just, like, really transparent conversations, I think it helps them get a sense as to, like, I'm not just trying to put everything into my deal, and I'm doing this for the long term, right? I plan to do this for the next 25 years. So.
Yeah, I totally, my first investors brings back memories. I had my first passive investor several years back, and he gave me a number they wanted to invest. And then he came back like a week later, or a few days later, whatever it was, and doubled that number. And I was walking with my now wife now, and I was like, tell my wife, I was like, you know what? I'm just going to tell, I'm like, he's never done this before. I'm going to tell him I won't accept that. And we got on a call, or it was by direct message or something like this. And at the same time on it, we both came to the same realization at the same time, that he was saying the same thing because he had reviewed it more. And I was, it's just, you just don't feel comfortable taking that from, it's like, listen, you don't really understand exactly how the whole thing works. You know what I mean? So it's something that's like, it's important for you to understand the whole thing of how this whole process works, because one of the things I hate most about syndicators is that when they advertise deals, they tell you about all this, the cash distributions and everything. It's like an annuity almost, and it's not. You know what I mean? It's a business, and anybody that went through, I guess 08 or anything with investors, but we went through COVID with investors, and it was like, what are you supposed to tell them? You know what I mean? You're like, hey, we're pausing this deal here, or we're cutting this one in half on distributions, because you're like, I have no idea. Nothing's not performing right now, but we don't know. Everybody tells me the world's ending. So it's like, it's just one of those things that you're like, this is what we have to do. So a lot of hard conversations you have to have with investors, but if but it also, you want to sleep at night too.
Well, I think that's a huge part, is just knowing that real estate is tough, right? Yeah. And there is risk. And I feel that oftentimes if you're new, like, it's just like sales, right? If all you ever talk about is the great things that are going to happen, and what I call like blue sky thinking, anybody that's been in business or been around for any period of time, and that has like real significant money, like when I'm raising money from people that might have 50, 100, 200 million, like they already know the good stuff. They want to know, like, are you prepared to talk about like the tough times and the things that are going to possibly derail the deal, right? Because they're more on wealth preservation and risk management. And so they're like, have you even thought through what are the negatives that could kill you in this deal, right? Like how do you stay alive? And I think, to your point, like, and the fact that you didn't take, all the investors' money, like that's huge, right? Because 9 out of 10 syndicators that, they would think that that's a win, but 2 years down the road, they might realize, I wish I wouldn't have taken all that in investors' capital because of COVID or whatever it happens to be. So,
no. So, and for future deals, whatever it might be, but really, it's just, you just have to act on, as a respect as you're working with a partner that you're going to be with for several years. You know what I mean? Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So one thing you mentioned earlier on, which I want to drill down now, is you mentioned that when you started in real estate, you were kind of scattered, let's just say, and you really, focusing and getting clear on principles has really helped me become successful in what I do. And how has it helped you and like propelled your business into where it is now?
I think the biggest thing for me is just the clarity and focus. You can really become an expert versus just constantly learning. Like you're going to learn, but I'd rather learn like nuances versus big expensive lessons, right? Like I don't want to have to continually figure these things out as I'm going. And like I tell a lot of clients, like, so on the construction side of our business, we'll get new developers coming through, and oftentimes I'll say, look, this deal, the one that you're looking at right now, it's marginally okay, right? Like I could probably make it work because I've done 10 of them, but I would go into it with the mindset that you're probably going to break even, or you might even lose a bit of money. So my suggestion would be like, are you planning to do 10 of these, or are you just trying to do one? Because if you're doing one, it frankly, it may not be worth it. And that's not what they want to hear, but it's the truth, because they just don't know what they don't know. And it's really hard to tell someone, okay, well, the city could do this and this could happen. And, the neighbor down the street could, roadblock you, or that power pole in behind might cost, $100,000 to bury, or whatever it happens to be. Like there's just so many variables that happen in a development, or the inverts when you tie into the city. They said they were at this, but they're actually much lower. Now you need a sump, or you need to tie in over here, or you need on-site storm. And there's these like unknowns that it's like the way it should be and the way it is, right? The way it should be is the plans are perfect and everybody does exactly what they're supposed to, and a carpenter shows up when he's supposed to, and everybody, holds hands and they do things properly. But guess what? That doesn't always happen, right? People don't show up. People get, like they quit. They do crappy work, whatever it happens to be. And so you have to, like, as a general contractor, as a developer, you're just problem solving. And so you just almost have to embrace that and know that, like, do I even want to do this? I've come to the realization I like it, and so that's okay. But I also have very clear expectations of what I'm getting into. And so if I was building offices, for example, right now, I wouldn't know what to expect on the construction side of things and what the tenant wants. And so, to your point, knowing, like, try to minimize as many of those variables as possible, I think. And that what does Charlie Munger say? Like, wisdom is like not having to solve problems, but avoiding them on the outset, right? So if you can avoid as many problems on day one because you have a pretty good idea because you've done it 10 times, I think that's really the strategy that I'm focused on right now, versus saying, oh, okay, well, just because I have this skill set, maybe I should apply it over here. Maybe I should go over here. And that's another reason why I even stay as close to home as possible. Because as soon as I start going further away from Calgary, I just know that I'm competing with someone that's been in that market for 10 or 15 or 20 years. And so when someone comes into my market and they don't know, they're going to learn some lessons. And that's just the reality. Just like I know if I go into their market, I'm going to learn some lessons. So if I'm going to go to that market, I better be kind of thinking, I want to be here for the next 20 years.
Yeah, that's one of those things that doesn't really show up in the underwriting, which I've seen if I passively invest in a deal or if we're partnering with an operator on the ground, is seeing exactly what kind of where their base of operations is, where their boots on the ground is, where they focus. And you can't see it from a spreadsheet. It's like the story, the narrative of that deal. But the thing that was that it's super important, and people don't look at that. They're like, oh, I see rent comps over here. And they don't move like 80 miles from where they are. You know what I mean? Like, this is like everybody's here. You know what I mean? So it's like, this is what they focus on. And that's like, you can't get that with a lot of different operators and developers. So super important stuff.
Yeah. And just to touch on that, like when we were going into the US, into Dallas and Houston to buy Class A apartments, the market was like, you could be across the street and it could be a different, like demographic and different market rents and different risk profile and different, like one of the things we saw in Houston specifically was like, what school district is it in? Meaning, what is the, like, how good is the football team? What's the program like? Right. And some renters, like in affluent communities, would like rent just so that they could have an address that their kid could go and play at this high school. And it was, it was very foreign to me being here in Canada, right? That wasn't as something that I'd really seen, but yeah. And a local would know that. But if you're, flying in 4 hours and you're starting to figure all this out, you start to realize there's probably a lot of things I don't know about this market that I got to get up to speed on.
Yeah, that's a great example. Great example. So as we wrap up here, what are some common mistakes you've seen, say, new or even experienced commercial real estate investors make, whether it's U.S. or Canada?
I think the mistakes that I see are probably from a strategic standpoint. I would say that they so this would be like just not having clarity or focus, right? Another one is partnering with people that have like non-complementary skills, and not having those kind of difficult conversations up front. I won't get into the details, but I remember like I was at a stage where I was going to partner up with someone, and I sent them kind of like a 2-page outline of, okay, roles and responsibilities, who's making decisions, how are decisions being made? What happens if there's a stalemate? Like all the things that I could think of because I'd already been at it for 10 years. And what was interesting is the individual didn't even respond to my email. And I had a friend that partnered with this person and is now going through some very difficult times. I'll just put it that way.
Yeah.
And it's because I don't think that they ever addressed like what happens if, and people don't want to think about that. They don't want to talk about it. They want to think, and I was like this so that's why I can kind of speak from experience is that you focus on all the great things that you can do together, that everybody is getting along, that we're friends, that money isn't going to get between us, that we can come to a resolution. And the reality is I have found that there's generally an alpha in every deal. And by that, I mean like someone that has the ultimate hammer to make the decision. And it could be on certain avenues. Like, so my partner now, I know the financing and the numbers. He knows the kind of the development and the construction side of things. So I don't try to like interfere over here. Like I understand what's going on and we have good conversations, but at the end of the day, I'm not going to jump into his swim lane and start making key decisions, just like he's not going to come over. And so there's that mutual respect, but that is not common and it's pretty hard to find, I think. I think the other challenge or mistake that I see new investors is they just don't see enough deals. So, I used to help newer commercial real estate investors get into their first projects. And so they would send me deals that they're looking at. And I kind of felt like a broken record where I was kind of, raining on their parade. But frequently I would point out all the things that I hated about the deal. How small the market is, how small the property is, like if everything works out well, you're only going to take this from this value to this value. And like, what's the risk to getting from point A to point B? And does it make sense? And why are you doing this deal? And, like just really trying to help them think it through. And it would be like my wife and I are looking at buying a new house. And so it's, kind of, I haven't looked at houses in 6 years. And so like, I had to like reset my brain. Like, what is 1.5 get you today? What does 2 get you? Like all these, the numbers and the bandwidth. Because I had this paradigm from 6 years ago, what a $2 million house is, and it's very different than what it is today. And so, I'm like, okay, guess what? Like, let's spend the next 6 months and go look at every friggin' house because I want to know like what good value is, and I don't know what that is today, right? If you show me one house and you say that that's the price, I kind of either have to accept it or reject it. But if I go see 100, then it's a very different story. Just like if someone's going to buy an apartment building or a retail strip or light industrial, like go look at 100, go talk to a bunch of tenants, go like immerse yourself in it, because guess what? If you're going to put $500,000 in and it took you 3 years to save that, why wouldn't you take 6 months and do everything you could to understand what you're getting into versus taking a broker's pro forma at face value and just crossing your fingers that it's true. So I would say that those are probably some of the things that I would think.
Yeah, those are some great ones. I love the one about the tenants, because that's something that I only hear that from experienced investors. You never hear like newbies like, oh, I talked to all the tenants and, all this kind of stuff. Because usually there's a problem that they have, right, when they're bringing this to you. Oh, yeah. But when you talk to tenants, then you're really getting the scoop on what's happening, right? There's no shiny brochures. They're like ready to move out for one reason or another, or they just moved in, or they're mad about something and they'll tell you about it. And as long as you want to listen. But a lot of great information there, Shane. So how can our listeners learn more about you, your business, and your podcast?
Yeah, I think my website. So just my name, Shane Melanson, Melanson, ShaneMelanson.com. And I think there's links to my book and my podcast and all that kind of stuff. And you can, I guess, learn a little bit more about raising capital or real estate developments there.
Yeah, a lot of great information in there. And then also his Club Syndication book there, How the Wealthy Raise Capital and Invest in Commercial Real Estate. So a lot of great information. Thank you so much for coming on today.
Thank you, Charles.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.